Okay, so we're looking at 13 and 14. You'll see support 13 and 14 is basically covering the same thing. It's looking at liabilities. So both of these go hand in hand. Obviously the one is looking at short term and the one is looking at long term. Okay, your basics are always important, we know that. Okay, so you need to know an asset is a resource and you need to know liability is an obligation. Okay, so if I have a resource, any item that meets the definition of a resource that's controlled, that gives future benefit, would be seen as a asset. If I've got something that's an obligation, obligation means, yeah, you have something that needs to be paid off or something that needs to be done in the future. Okay, and the future outflow of economic benefit makes this a liability. So obligation is the keyword, resource here is the keyword. The one gives rise to an inflow, the one gives rise to an outflow. When looking at assets, we've covered these, non-current and current. We've looked at PPE, that was the depreciation chapter, okay, where you did carrying value, cost, and you calculated. Here we looked at current, which is the debtors, and we looked at the inventory, which is periodic and perpetual. So those are two separate chapters, also in the textbook. So they've literally taken like piece by piece by piece by piece, and then you'll put it all together, then you'll make a financial statement or a set of financial statements. So when focusing on PPE, PPE is looking at long term, trade receivables and inventory is looking at short term. Intangibles are things that are not tangible, meaning they're like copyrights, okay, websites, brands, etc. Okay, they're not physical assets, they're rights to do something, so contracts or things that cannot be held, okay, like a brand or a copyright, or it's not a physical asset. Okay, so now we're looking at liability. So obviously a liability is a very specific account. SU. Okay, a liability is going to focus on what? The obligation. Okay, so why do we have these obligations? They arise because you transact. Okay, so when will you have a non-current liability, like a long-term loan? It's normally when you finance or buy vehicles, property, plant, equipment. Okay, large items of machinery. Okay, land, buildings, etc. Okay, so when looking at liabilities, obviously the non-current liabilities are long-term. So your long-term loans or bonds are going to be used to finance those long-term assets, land, machinery, etc. Current is obviously short-term. So then when do we have creditors? Well, creditors are our suppliers. So we'll normally have a creditor when we have to buy inventory, okay, or we'll have a creditor when we're purchasing goods or buying certain things. When looking at bank overdraft, that's something we looked at in the bank recon. Okay, obviously the bank recon is going to have a positive or a negative bank balance. If it's a negative bank balance, it's seen as an overdraft. That's negative, so it'll have a credit balance. That's the current liability. Okay, so when looking at non-current and current, when I record assets, what do I do in my books? What do I debit, what do I credit? In my books.
Asset is debited.
Yes, why?
Because it increases on the debit side.
Yes, and why does it increase? It's because you've purchased an asset, and if you're buying an asset, it's going to be affecting which two accounts? If it's cash, which account would it affect?
Bank.
Okay, it will affect the bank if it's cash, and if it's credit,
Debtors.
it would affect the debtors. Yes. Okay, so no, not debtors. You said debtors. It'll be a liability. Okay, it's bank or liability. So you shouldn't have said debtors. You should have said creditors. Okay, debtors are people who buy from the business, meaning you're owed. So they're seen as a asset, okay, benefits. Okay, creditor is obviously a liability. Okay, there's an amount outstanding that's going to be paid over to the let's say parties involved. Okay, so resources are controlled by the business, so that'll be an asset that I can buy and purchase. So the asset will go up, and then I'm either going to use cash to buy it, or I'm going to use a loan liability. Okay, and the liability will then affect your disclosure. Okay, because obviously disclosure here is different. Right, bank would be an asset, liability is a liability, credit is a liability. Okay, so a resource is an asset that we control, gives rise to future economic benefits. When looking at liability, we're focusing on those obligations, things that we're going to be using in order to acquire those assets. Right, because that's what businesses want. Businesses want assets in order to operate. The more assets that the business has, the more productive they should be, so long as they're using all the assets. Okay, there's no point having all your assets or having lots of assets if none of them are being used. Okay, it's not about how much you have, it's about what you're doing with what you have. So a business, it doesn't matter how big or small, will want more assets because they know there's going to be future benefits. And obviously to get those assets, what must we do? We need to buy them. Okay, so either use cash or liabilities. Okay, so most companies are going to have to use liabilities to purchase those assets. Okay. When do liabilities occur? When you buy on credit, yes, that's one scenario. So when there's an obligation, do you agree? Okay, so if I take out a loan, will a liability occur? If I buy something on the credit card, will a liability occur? Yes, okay, because there's an amount that's outstanding. Okay, so the key is that obligation bit. So the ones that you'll see are accrued expenses, you'll see future obligations. Okay, things that will happen in the future. Buying on credit, that's the one you mentioned. Okay, creditors. Okay, so liability has a very specific definition. Obligations that give rise to future outflow of benefits. So if I'm looking at the recording of the liability, what am I going to do in my books? What am I going to debit? What am I going to credit? What will happen to the liability if I'm recording it in our books? It's going to go up. So you debit or credit? You'd have to credit it, exactly. So the rule stays the same. You can't change that. I'm going to have a liability. It'll either be long-term or short-term. So I'll call it a loan, or I'll call it creditors, or I'll call it something. But then I'm going to be financing or buying assets or paying for expenses, depending on what it is. Okay. Right, so that's the definition in terms of assets and liabilities. Obviously, study unit 13 is looking at current liabilities. Okay, so short-term liabilities, things that we're going to be using day to day in the business. Okay, so what are the different liabilities that you can get? Well, if I'm looking at short-term operations, what's the most common liability that a business would have in terms of operating? Creditors, right? Okay, we rely on our suppliers a lot. Why are suppliers good to the business? How do they help the business? What benefit do we get from having a creditor?
We get stuff to sell.
Exactly. Okay, so you're buying today and you're paying later. Okay, if your suppliers give you good terms, better or worse?
Good.
It's better. Okay, because the terms mean I'm going to have to pay them later rather than sooner, and that will benefit the business. If I can pay later, that's going to help the business. Okay. What happens if we do not pay our incurred expenses during the year? Is an obligation.
Yes.
So what's the obligation called? Think about it. You've incurred an expense that you haven't paid for. Accrued expense. Okay, remember those adjustments that we looked at in chapter, I think it was 7? Okay, an accrued expense is one of the current liabilities that you could be asked to adjust for in the books of the business. Okay, what happens when we buy merchandise and credit?
Our liability increase.
Which one? Creditors. Creditors will increase. Creditors would be a liability that's financing an asset. In other words, the inventory. Okay, you're buying the stock, so your creditors would be affected negatively, and your stock would go up. It'll be increasing positively. Okay. Right. So debiting the inventory, crediting the creditors. Can current liabilities arise when there's a short-term obligation? Yes, and it could be any obligation. It doesn't have to be creditors and accrued expenses. As long as there's a short-term obligation, there's going to be a current liability. How do we measure them though? So if we think about creditors, if we think about accrued expenses, if we think about short-term loans, how do we measure them? What are we going to be using to measure them? Think about a loan. How would you know what the value of the loan is? Yes, okay, so you would look at the statement. So you would get maybe a statement on the actual outstanding balance. That's fine. So is that balance going to change?
Yes, if you pay.
If you don't,
No.
it'll increase. So it'll still change. Interest is going to compound. Okay, so when looking at a liability, they normally talk about the cost, the realizable, or the current value. Or, as we know it, balance outstanding. Okay, because we would be looking at like credit card debt, loans, home loans, etc. Okay, it's all looking at obligations. Okay, so the key word is always the definitions. Okay, obligations. If you know a liability is an obligation, it doesn't matter what liability they give you, you're still going to follow the same rule. You can't change the rules. You can change the name of the account, but you can't change the rules. It is what it is. So creditors is creditors. Accrued expenses are accrued expenses. Okay, they're both liabilities. Right, so we've seen this before. This is structure for the statement of financial position. If I'm looking at current liabilities, I'm going to be showing it separate from my total liabilities. Okay, you need to separate between long-term and short-term because users want to see the difference. Users want to know how much do you owe long-term and how much do you owe short-term. That gives them a better idea of how to manage the business. Okay. Here's a note about the journals. Looking at current liabilities. If I've got a purchaser's journal, what account will always be affected? No, bank wouldn't be affected in the purchaser's journal. Why? There's no cash.
Oh, yeah.
You're not receiving or paying. So what transaction will always be affected in this account? Purchases? Well, yes, in a sense, because you're buying stock, but you could be buying other things as well that will go to sundry account. Is there one account that will always be affected? Creditors, right? Trade payables. Why? There's going to be a liability. If I'm buying something on credit, there's going to be a liability. And the liability will always have what balance? Credit balance. Okay, liabilities have credit balances. It's very unusual to see a liability with a debit balance. It's not impossible. You can get a liability with a debit balance. That's if you've paid too much. Okay, so you've overpaid a supplier. If you overpay your supplier, they actually become your debtor. Okay, because you've overpaid. Okay, so if I overpay, that means I'm owed something from the business. Does that make sense?
Yeah.
Okay, so you would have assets there. Obviously, we spoke about capacity. Businesses want assets to operate. Okay, what do I debit and credit in the purchaser's journal?
Credit liability and debit purchases.
Good. Okay, what is the liability called though?
No.
Creditors. It's a purchaser's journal. Okay, it's day-to-day running of the business. Purchase returns. What type of account is a purchase return?
So creditors will be debited.
Yes. Okay, the opposite. And what will be credited? The asset or the expense? Okay, you're reducing it. Okay, a note here about cash payments journal. You can see creditors in the CPJ, right?
Yes.
Why? You pay your outstanding?
Balances.
Creditors, yes. Okay, so you're going to pay for liabilities at some point in time. And there'll be a cash payment that's going to be processed, which relates to the creditors. Is there a special account that you can see in the cash payments journal that arises when you make a payment? What special account can arise when you make a payment? Well, let's talk about the purchase. When you purchase something, what do you debit or do you credit?
Purchases will be debited
Yes, and?
and creditors will be credited.
Correct. Okay, so that's the case. That's the purchase. Okay, well, the answer's actually there now. Okay, discount received. Do I always pay the full amount?
No.
Not always. Sometimes the cash payment will only be for the net amount because they offer you a settlement discount. Okay, why do businesses offer discounts? It's to incentivize early payment. Okay, businesses don't want to wait too long in order to receive payment. Businesses want to receive payment as soon as possible. So in order to incentivize early payment, they might award us a discount that's received on the outstanding balance. Okay, so how much do you owe? Let's give you a discount so you can pay off your debts. These are some of the other current liabilities that you can get. We spoke about VAT not so long ago. VAT is obviously a liability if which is bigger, input, output. Output. Why is output?
Yeah.
Why is output bigger? Why must it be bigger to have a liability?
Output means you need to pay that.
Who? To who?
SARS.
Exactly, to SARS. Okay, so output VAT is the liability. Okay, input VAT is obviously the asset. The difference between the two is going to give you the amount payable. Right, so if there's a payable amount, that means I need to pay off my amount that I'm owing SARS. Okay, because SARS keeps tracks and tallies on the different individuals and businesses. Okay, other things, borrowings or loans you can get. Accrued interest, accrued interest expense would be interest that you haven't paid. Accrued interest income would be something that you haven't paid in terms of the what do they call it? The compounding. Like, so for example, if you don't pay off a loan, does the loan get bigger or smaller?
Bigger.
The loan gets bigger because of the compounding. Right, so a borrowing would create an accrued expense because the accrued expense means you have to pay off the interest on that loan. Okay, if you don't, then there's obviously going to be problems with maybe the relationship between you and the individual, okay, owning the property. Okay. Income received in advance, is that a liability?
Yes.
Why is it a liability?
Because you owe them services or products.
Yes. Okay, there's an amount that's outstanding or owed. Correct. Good. Okay, would a provision be classified as a liability?
Yes.
No, a provision won't be. Why? What is it called? What is it called? Negative assets. A provision is allowance. It's just another word for the allowance. Like provision for doubtful debts.
Oh, okay.
Allowance for doubtful debt, same thing. Or allowance for credit losses. Okay, so provision or allowance is just something that's provided for today that relates to the future. Okay, if it's a provision, so accrued expenses, what else could you get? Accrued water and electricity, that's also billed in arrears. Would all be seen as current liabilities. Okay, because it's short term. Current liabilities means short term. Okay, so are all these accounts going to have the same balance?
No.
Which one won't?
The provisions.
Well, correct if you're adjusting the provisions, but the provision will always have a negative asset balance. Okay, negative asset means credit balance. Okay. Right, so all the accounts will have a balance. You'd have to balance off the accounts. And they'll have what type of balances? Credits. Because they're current liabilities. Okay, all of these will have credit balances. Right, so plus and minus. Okay, so if I'm increasing an allowance, will I debit or credit the allowance? If I'm increasing an allowance.
You
I would debit. Why would I debit?
To increase it.
No. If I'm debiting an allowance is it's a negative asset. It's a bad debt, right? Okay, so if the allowance is seen as bad debt or allowance for bad debt, it wouldn't be seen as an income. It wouldn't be seen as a expense. It'll be seen as a almost like like a liability as such, because it's a negative asset. The allowance is providing for something bad in the future. Okay, so I think my debtors aren't going to pay me. So if I think they're not going to pay me, I'm going to create a provision. Okay, and the provision will have a debit or credit balance. Which one?
No debit.
No.
No credit, sorry.
Yes.
Increases on that.
Okay, a provision will have a credit balance because it's offset against a assets. Okay, because you normally take off your allowance for credit losses against which account? Your debtors, right? Okay, don't we take off the non-current assets from, not non-current assets, allowances? Do we take off those non-current, do we take off the allowances for bad debt against the non-current assets? Yes, you would, because it would make a more accurate picture. Okay, so I'm writing off a certain amount to my inventory. Okay, that's pretty much the theory for that module. It's not a lot of theory. A lot of it is revision, actually.